These are technology adjacent companies. They're massive in value, and they've taken a beating. Is it going to stay that way?
Well, these are some of the most challenging, backdrops, environments that I've seen for tech and growth stocks in quite some time. And you now got a pincer movement. So you've got, rising interest rates are always a negative for long duration assets. Although those 5 companies that you mentioned have got a lot of free cash flow support to them. Nonetheless, higher interest rates have have a negative headwind on long duration assets, tech assets, growth assets. And then you've got softening macro conditions. So you've got a risk to the multiple, and you've got a risk to the earnings, or you've got a risk to the PE and a risk to the E, if you want to think about it that way. It's a very tough environment for these stocks. My guess is that basket of stocks can outperform the market over 12 months, and these are good valuation levels that we'll look back on and say, we wish we had bought more then. But there's no particular reason why you can call the relief point. Given those 2 pincer movements, I would think that the macro trends are going to get tougher before they ease.
Mark, you've been watching the markets in these stocks for quite some time now. Do you remember a time when you've faced this kind of a valuation issue as well as an economic issue? I mean, since the end of the great financial crisis back in 2009-10, it's been up and away for tech stocks. They've always outperformed. It's been a relatively very low interest rate environment. So what happens now? Are they still relative safe havens like they've been over the last 12 years? Every time the market goes down, they get bought? Or does a rising rate environment change all that? And if so, when's the last time we saw that?
Well, you're right. We had a very unusual environment the last 2 years in particular, but the last 10 years with lower than average interest rates, the last 2 years dramatically lower than average interest rates. And we've had some phenomenal stock outperformance. Now, some of this is just going to be reversion to the mean. 2 years of dramatic outperformance in 2020 and 2021. Somewhere along the way is going to lead to underperformance. You have that here. I think within tech and with growth, though, you can find kind of more value-like names. I think mega cap offers you that. I think as an investor, what you want to do is find the highest quality growth tech names. And I find it hard to believe you wouldn't include Amazon, maybe a Google, a Meta in there, at least definitely the first 2, and probably Meta. And these valuations, the sector as a whole, at least the consumer internet sector, overrated. I mean, the multiples went up dramatically in 2001, probably on the false premise that interest rates would stay low for a long period of time and that there were permanent wins from the COVID crisis. There were some wins. There were some permanent wins, but not nearly as much as it was implied in the valuation. That's easy to say with hindsight, I know. Anyway, I look at these. The market gets back to fundamentals at some point. I don't think it's, it may not be weeks away, but it's not years away either. And I think if you have a 12-month or longer investment horizon, if you get a chance to buy Facebook or Meta at 13 times earnings or Google at 17 times earnings, I think those are good entry points. And those stocks, those fundamentals will come through for you. So I hope that answers the question. You also want to look for stocks with clear catalysts. So that's one of the reasons I just upgraded Netflix, because they've got a new advertising stream. But you want clear valuation support or a clear fundamental catalyst going into 23. There are a few spots that offer that.
Mark, we're flashing all of these charts, and the one thing they all have in common, including Netflix, which you're showing right now, is they've taken an absolute beating. Catalyst-wise, do you think there's anything that we have to look at for these mega cap tech names beyond interest rates? And you mentioned the ad tier for Netflix and everything else, but what gets you that kind of like, hey, let's go in and buy these names?
Well, it has to be valuation. Now, you do have in some of these names like Amazon, Google, and Meta, you had very challenging comps in the first half of this year because they were such fundamental beneficiaries of COVID trends. And so as you go through the back half of the year, the comps are going to get easier. Revenue growth is going to accelerate. Normally, when you have revenue growth acceleration and margin expansion, multiples at least hold, and oftentimes multiples go higher. One of the reasons I like Amazon is the stock is trading about 30% below its pre-COVID multiple. So I've got a setup here where fundamentals are going to inflect up. The recession question is the rate that they inflect up, but they will inflect up those fundamentals. The shares should re-rate modestly.